Imagine getting paid instantly for your exports without waiting months for payments. That's the magic of factoring. But how exactly does this ancient financial tool work in modern international trade? Whether you are a student, a business owner, or just curious about finance, this topic will give you a new perspective on how companies keep their operations running smoothly. Let's dive into the topic factoring. Factoring started over 4000 years ago in Mesopotamia during King Hammurabi's time. It was one of the earliest financial tools used to help traders get paid faster. In colonial America, merchants in Europe gave money in advance to the colonies for goods like cotton and timber. This helped the colonies keep working without waiting for payment. These were not banks, but factors who paid based on what sellers were expected to earn. As time went on, especially during the Industrial Revolution, factoring became more about checking if customers could pay back. This led to non recourse factoring, where the seller doesn't bear the risk if customer fails to pay. Today, factoring is still widely used by businesses to improve cash flow. It can be done by big financial companies or small private firms. The idea remains the same: get quick money based on sales made on credit. To support this, the Factoring Regulation Act 2011 was notified on January 22, 2012 by the Government of India. The Act defines the legal framework for factoring transactions, including the roles, rights, and responsibilities of all parties involved. In simple terms, factoring is a financial arrangement where a company sells its receivables, that is, unpaid invoices, to a third party called a factor in exchange for immediate cash. The factor also manages credit control, sales ledger, and debt collection. Factoring is an ongoing legal relationship where a financial institution, that is, factor, purchases a business's receivables with or without recourse, manages customer credit, and handles collection, improving cash flow and reducing financial risk. Under full service factoring, if the buyer defaults, the factor absorbs the loss. This is called non recourse factoring. This service evolved from simple consignment selling to a comprehensive financial solution. Unidroit, an international body, later defined factoring as an agreement that includes at least two of the following. The first one is debt administration. The factor manages the client's sales ledger, invoicing, credit control, and debt collection, saving administrative costs. The second one is credit protection. The factor assesses customer credit worthiness using financial data and market intelligence, reducing risk. The third one is finance against receivables. In India, factoring usually includes advancing up to 75 to 80% of the invoice value to the client. Factoring covers both domestic and international business. Let's understand them one by one. The first is domestic factoring. Domestic factoring helps businesses get their vendors or suppliers' payment financed by banks or factors. There are two main ways this happens. Either the bank gives credit directly to the business that needs to pay. That is, this is like a special loan for making those payments, or the bank sets up a limit for each of the business's suppliers, allowing them to get paid early. Importantly, these arrangements can come with or without recourse, meaning it affects who takes the loss if the buyer doesn't eventually pay. The next is international factoring. In international factoring, there are usually two factors. The export factor looks at financing the exporter and sales administration, presenting invoices at the right time and collecting payments being their key tasks. The import factor evaluates the buyer, collects the proceeds on due dates, at the same time ensuring that he is protected against default. International factoring encompasses all four services, that is, prepayments, sale ledger administration, credit protection, and collections. Next, we look into types of international factoring. Based on exporters' requirement and their capacity to bear costs, several forms of international factoring have emerged. Among these, the most prominent and widely Practice types include two-factor system, single factoring system, direct export factoring, and direct import factoring. Let's understand them one by one. The first type is two-factor system in international factoring. The two-factor system is a commonly adopted method in international factoring, particularly suited for exporters dealing with overseas buyers. This system involves collaboration between two factoring companies, each located in the exporters and importers' respective countries, and connects four primary entities, that is, exporter, importer, export factor in the exporter's country, and import factor in the importer's country. Now let's understand the operational workflow in two-factor system. The exporter provides the export factor with comprehensive business details, including nature of business, debtor name and addresses in importing countries, anticipated annual turnover by country, number of invoices and credit notes per country, payment terms, required credit lines for each debtor. The export factor contacts the relevant import factor to evaluate the creditworthiness of the listed importers. The import factor assesses the feasibility of offering credit protection. If viable, it specifies the credit limit, commission, and cooperation terms. If not, the export factor is advised to explore alternatives. An agreement is finalized between the exporter and the export factor. After the goods are shipped, the exporter sends two copies of the invoice to the export factor. Based on this, the export factor disperses a pre-agreed advance to the exporter and forward the invoice to the import factor. The import factor undertakes the responsibility of debt collection and remits the recovered funds to the export factor. Should the importer default, typically after 90 days of the due date, the import factor covers the payment from its own resources, excluding cases involving disputes related to quality, quantity, and contractual condition. Once payments are fully recovered, the export factor releases the remaining balance, usually 20 to 25%, deducts its service fees, and remits the agreed commission to the import factor. Export factor and import factor. What are their roles and responsibilities? Let's see. Export factor's roles and responsibilities is to assess financial condition of the exporter, coordinate with the import factor to evaluate importer creditability, provide pre-shipment financing based on receivables, track payment collections with the import factor, and allocate commission to the import factor. Import factor's roles and responsibilities to maintain records of buyers, that is, debtors in the import country, collect outstanding payments from importers, transfer recovered funds to the export factor, and offer credit risk protection for importer insolvency. The two-factor system is widely regarded as an efficient and reliable international factoring model. It provides exporters with structured financing, risk coverage, and professional receivables management across borders. The second type of international factoring is single factoring system. To overcome some limitation of the traditional two-factor model, the single factoring system has been developed by factoring firms associated with the Factors Chain International Group, that is FCI. In this arrangement, a special bilateral agreement is established between the export and import factors, while the import factor still provides credit protection as in the two-factor model. The role is more limited. If the export factor is unable to recover payment within 60 days of the due date, it notifies the import factor and the concerned debtor, transferring the debt collection responsibility. The import factor then takes over the collection process and may initiate legal action if required. If the payment remains overdue for more than 90 days, the import factor is obliged to settle the amount under its credit risk guarantee. This system is more cost effective than the two-factor model since the import factor acts only when recovery issue arise. They do not maintain a dedicated ledger for the exporter and rely solely on the export factor's records. Hence, effective coordination and mutual trust between both factors are essential for successful execution. Now, the third type of international factoring is Direct export factoring. In this model, only a single factoring company, referred to as the export factor, is involved. The export factor independently provides all factoring services, including pre shipment financing to the exporter, maintenance of the sales ledger, collection of receivables from foreign buyers, and credit protection in case of import default. Next, that is fourth type of international factoring is direct import factoring. Here the exporter chooses to work directly with the factor located in importer's country. This import factor manages sales ledger administration, receivables collection, credit risk protection within agreed limits. Since the exporter and the import factor operates from different countries without direct interaction, communication and issue resolution may be slower, potentially leading to challenges. Now we shall see the advantages of export factoring. Export factoring offers several benefits over traditional trade financing methods. They are immediate access to working capital, that is, up to 75 to 80% of invoice value can be financed right after shipment. No need for letter of credit, that is, transactions can proceed without LC requirement. Global credit assessment, that is, the factor assesses the creditworthiness of buyers through partners or international rating agencies. Comprehensive sales ledger management, that is, the entire accounts receivable process is handled efficiently. Full credit protection, that is, approved invoices are covered up to 100%, ensuring consistent cash flow. Currency risk mitigation, that is, services may include hedging against foreign exchange fluctuations. Export advisory services, that is, guidance is provided on regulatory requirements and commercial practices as applicable to the importing countries. There are different types of factoring, that is, disclosed factoring and undisclosed factoring. Let's understand them one by one. The first is disclosed factoring. In disclosed factoring, clients' customers, that is, customer of the factor, are aware of the factoring agreement. Disclosed factoring is of two types, that is, recourse factoring and non-recourse factoring. In case of with recourse factoring, when the customer, that is, buyer, fails to discharge a liability, the factor will look towards the client, that is, seller, for making good the amount. In case of non-recourse factoring, when the customer, that is, buyer, fails to discharge a liability, factor will absorb the loss but cannot go to client, that is, seller, for recovery. The next type is undisclosed factoring. In undisclosed factoring, seller is not aware of any agreement between the buyer and the factor. In this case, client has to pay the amount to the factor if the customer doesn't pay. Export factoring on non-recourse basis. Let's see. Reserve Bank of India permitted authorized dealer category 1 to provide export factoring services to exporters on with recourse basis by entering into arrangements with overseas institutions for this purpose, provided guidelines issued by the Department of Banking Regulation in this regard are complied with. Taking into account the recommendation made by the Technical Committee on Facilities and Services to the Exporters, RBI decided to permit AD banks to factor the export receivables on a non-recourse basis so as to enable the exporters to improve their cash flow and meet their working capital requirements subject to the conditions as under. AD banks may take their own business decision to enter into export factoring arrangements on non-recourse basis. They should ensure that the client is not overfinanced. Accordingly, they may determine the working capital requirement of their clients, taking into account the value of the invoices purchased for factoring. The invoices purchased should represent genuine trade invoices. In case the export financing has not been done by the export factor, the export factor may pass on the net value to the financing bank institution after realizing the export proceeds. AD Bank, being the export factor, should have an arrangement with the import factor for credit evaluation and collection of payment. Notation should be made on the invoice that importer has to make payment to the import factor. After factoring, the export factor may close the export bills and report the same in Export Data Processing and Monetary System, that is EDPMS of the Reserve Bank of India. In case of single factor not involving import factor overseas, the export factor may obtain credit evaluation details from the correspondent bank abroad. KYC and due diligence on the exporter shall be ensured by the export factor. Thank you so much. Stay tuned.